Retirement Podcast, where we share real-life stories and strategies that we've used to help hundreds of families retire with confidence. Your host is certified financial planner Jim Cox of McCarthy Cox Retirement and Estate Specialists. McCarthy Cox embodies small-town midwestern values and is dedicated to building better tomorrows.
Welcome, everybody, to Toast to Retirement Podcast. Our guest today, our esteemed guest, is our Chief Investment Officer, Wes Bean. And Wes, welcome, first off.
Thank you. Nice to be here.
Absolutely. And we've got an amazing, exciting announcement here today. Groundbreaking, I think, is not I don't think we're overstating by saying, it's a huge thing. Which is also why this is the number 3 podcast. That's how important this is. It's our third one.
Big. So I like it.
It's huge. It's huge. Wes, and we're going to get into what we're talking about. We're going to get into the specifics in a few minutes. Before we do that, the theme of the podcast is Toast to Retirement. And if anyone's watched the first 2 episodes of this, they saw that Tony Dalton, who's our Chief Operating Officer, chose pressed fruit juices as his drink of choice. Our guests get to choose the drink, and I don't know if this was I don't know if I'm being punked. I think it might be something like that. When we created the idea, I was like, well, we'll do some nice wine or nice bourbon or something like that. And so, Wes, what did we choose today?
Orange juice.
Orange juice.
There we go.
Go ahead. Is it cold pressed?
No, it's not cold pressed.
It's from
concentrate. It's even worse.
This is great. This is a high end podcast, man.
Yeah.
Our budget is
it's work hours though too, right? And I didn't bring the kind of juice that Tony brought because you said it was gray or it was.
We did 2 of them, and I actually think we kind of had to redo a couple of them. So one of them was like a lime green kind of thing, it was kind of looking like almost like asparagus or something. And then the other one was like kind of a grayish color. That one didn't look. But his second one, he did he was nicer to me. It did come across as fruit forward.
Okay, that's not fruit forward. I like that.
Yeah.
Nice. This is fruit orange juice forward.
Wes, you've been with us. You've been our Chief Investment Officer for going on 9 years.
9 years now.
9 years this summer, right?
9 years this summer. 9 years in June.
And why don't you tell us just a little bit about yourself, your background, where you hail from, et cetera, et cetera.
So I grew up in North Carolina, born and raised in Salisbury, huge town of Salisbury, North Carolina, famous for Cheerwine, if anyone's heard of that or seen it in Kroger up here. Food line. Cheerwine. It's a soft drink. It's from my hometown. Kroger's just now.
Not Coca-Cola.
No, it's not Coke. Pepsi came from North Carolina. So,
okay.
But no. Grew up in North Carolina. As far back as I can remember, 6, 7, 8 years old, I remember sitting on the fireplace with my dad, looking at the pink sheets, trying to pick the next big stock winner in the newspaper. So I've had this huge just interest and fascination with finance since I was a little child.
Specifically
investment world. I love the investment world. Moved to Ohio about 15, 16 years ago. Worked with Nationwide, and that brought me up here. I love it here. It's really nice. Got my 2 daughters live with in Delaware. And really into IndyCar and NASCAR. NASCAR is really big down in North Carolina. I grew up around that, and it carried over to IndyCar when I came up here. And I have been to Disney 28 times.
So
mention that.
So yeah, I saw his intro or his bio or whatever else, and at no point did he mention his affinity at the very lowest level. I could say this, maybe obsession be a better word.
Upset
with Disney.
It's fair.
How many times have you been to Disney?
28
times.
I told Jim earlier that's
why Disney is a mega, corporation, global.
Mm-hmm. It's
people like you.
People like me, but not anymore though. It's I think they priced me out finally. Yeah. It's
how much is it now?
It's the tickets. I mean, you can go down there for about $7,000 or $8,000 for a family of 3 or 4. But if you want to really have the nice experience, tickets now, there's some tickets you pay $300, $400 a day for per park, and that's just too much.
I heard the fast pass is better though. We did that with the kids when they're a little bit younger, maybe about 5 years ago, and they had that genie thing, and it was you got to ride one ride. One ride was that you didn't have to wait for, but you paid X amount of dollars. I'm like, it was I thought it was the worst experience. Like, and I didn't want to go back because of that.
See, I just figured Genie out. And now we have this new thing it's a whole different system.
I got to start over. Is that so? Which one is it really? Is it the cost of the going, or was it
it's all
last learn new things?
Yeah, it's learning new things and paying a ridiculous price for it. So it's a combination. Yeah.
I like that. So let's jump in because we've got an amazing announcement today. We're launching. Well, let me ask you a question. I'll do a little test. 9 years ago, do you remember the lunch that we had when we were interviewing for this position?
I remember it. I remember almost every.
What did you have for lunch? I'm just kidding.
Oh no! I know.
I know how you know.
I'm fairly certain I had a French dip sandwich that day.
Oh, I bet you did. They had a good one.
I think
it was at the Old Town Inn.
Yes.
It's now been, that location's been 4 different restaurants in 9 years.
At least, yeah. Yeah, I'm fairly certain it was the French dip, but I do remember that conversation.
We jibed. It was a very long conversation as I remember. It was 2 to 3 hours long.
Yeah.
It was, we kind of were sharing what our thoughts were, or dreams, I should say, maybe a little bit more, and objectives of hiring a director of investments, and some of the ideas, and some of the things we wanted to accomplish right away. Giving our clients the best investment experience they possibly can. The crossing the T's, dotting our I's, being as professional as we possibly could. Was version 1.0. But then we kind of geeked out a little bit and went much longer on the dream board ideas.
Yeah.
And one of which was to launch an investment product designed for retirees. And guess what?
It's crazy.
You guys,
yeah.
So Wes has an assistant, Previn. So Wes is a chartered financial analyst, which is basically the highest, certification that you can get, right, in
the investment world.
In the investment world, I mean, and it was years and years and years of studying, and it's very difficult. It's very, they cut a lot of people. They don't let them pass. It's a difficult test to get. So we're one of the very few firms that have a CFA on staff. I mean, it's very, prestigious level. And then you bring in an assistant who is on the journey. He's now past his level one.
He's sitting for level 2.
And Previn's amazing. You guys have done so much hard work.
Oh.
I'm going to let you announce this. We're launching something called
Trio ETF.
A Trio ETF, MC Trio, right?
The MC Trio Buffered ETF. This is going to be amazing. Buffered Equity ETF, ticker symbol TRIO.
Nice. So it's publicly listed.
Publicly listed as of March 6th.
Wow.
Yes.
Very
exciting. Very exciting.
It was one of our dream board ideas, and it's just one of those things that you go, I don't know. I don't know. I've met and became friends with definitely in the hundreds of financial advisors, and I've not met anyone who's launched their own investment product that's listed on an exchange.
Yeah, and nor have I. I've been in the industry for a long time. Also, I don't look a day over 30, but I've been in the industry maybe longer than you, right? But no, I don't know anyone else. I know one
much older than me
firm in North Carolina that launched one. Maybe a little, little. But no, this is a truly unique thing. For a firm of our size, it's just phenomenal to me. This is a big thing.
Tell me what it is.
Okay. So the Trio ETF, this is an exchange traded fund. A lot of you may be familiar with mutual funds. This is an ETF is just kind of the next iteration of a mutual fund. So it's money pooled together and it trades daily throughout the day. It's like a stock or a bond would, and you go out and trade it on an exchange. So the great thing about this is we did a lot of this stuff privately, like this type of investment for clients privately, and now we're able to take it out with this ticker symbol and put it on a public exchange for it to trade. And the good thing, again, it's an ETF wrapper, so it's really efficient, trading good liquidity, daily liquidity, and all that.
Tell me, what does it mean to be that it's a buffered ETF?
So the
buffer mean?
The buffer's actually, that's the really cool feature of this. If you think about the market, and let's simplify the market and say the S&P 500 or SPY. So if you can go out, you can go into the marketplace and you can buy SPY, and you got market
which is
exposure.
I think the number one. I don't know if it's SPY, but the S&P 500 index funds and ETFs, right? When you combine them together, it kind of work the same.
Yeah.
Low cost, buy the index and forget it, right?
That's it. That's it.
That's the number one investment in the world.
And that's it. And that's anytime you look on TV, CNBC, that's what you see, the S&P 500. That's
where the majority of the money invested in the stock exchanges is in the S&P 500 index.
That's it. Absolutely. And so what this is, if you think about just the S&P, we took that exposure and we put a buffer. We put a 10% cushion, if you will, with that.
So a 10% cushion, meaning 10% downside protection.
Exactly.
Okay.
So, and we'll leave
over a what period of time?
Over 1 year.
1 year. Okay.
So we've done some other things to it, but just think about that in its simplest terms there. Over a 1 year period of time, you're going to get a lot of the market upside, and I'll explain that in a minute, but you're buffered against the first 10% of losses. And that's the critical part right there.
So market goes down 8%.
You get your money back. You lose nothing.
Market goes down 11%.
You lose 1%.
So any loss beyond the 10% down,
you're on the hook.
You're on the hook. But that's the same as you would be in any other situation, right? Like, except for you'd be
minus that. Yeah, minus that buffer. You're on the hook for the whole thing in the S&P 500. If you're just an SPY.
Why is that so important? Why is that downside management so important?
One thing, if you think about back in 2008, 2009, a lot of people lost a ton of money in the market. And I think there's a joke about a 401k becoming a 201k.
Sure, yeah.
So if you lose 20% in the market or 20% anything, it takes 25% to get back to even.
Right.
So just to get back to
20, if you lose 20 and you make 20 back, you're still back to even.
Yeah, you're still underwater. So if you lose 20, you have to make 25 just to get back to even.
And back in that example of 08, 09, the 401k become a 201k means because the stock market lost 50%.
Yeah, and then
so then
100%.
So then you have to get 100% return.
Even.
Not a 100% rate of return to get back to
get back to even. And that's why losses are so much harder to make up, like from a pure math perspective, but from a psychological perspective, they're really tough too.
Yeah, so your choices are, we talked for a little bit about ETFs and the majority, the largest investment being the S&P 500. But talk to us a little bit what makes it a trio.
Okay, that's a good point. The trio, most people don't invest their money. If you think about your retirement money, you're not going to take all of your equity money and go out and buy S&P 500, just that index fund. So that's not how most people invest. That's not how we want to protect our investments or put our protection on either. We want to protect our whole portfolio. Most people are going to have some large cap stock exposure, small cap stock exposure, international exposure.
Eggs in different baskets.
Yeah, that's it. That's what the trio is. So we have 70% in the S&P 500. We get that large cap exposure. And we have 15 in the small cap index and 15% in an international index. So again, it looks a lot more like most people build their investment portfolio. Because like I said, you wouldn't go out and buy, some people wouldn't. We don't preach going out and buying a top-heavy index like the S&P 500. We want to diversify. This is just taking that diversification a step further.
And, so with one ticker, right? With one ticker, which is?
TRIO. Trio.
Trio. So with one ticker, they can get into this investment product. It's very diversified, international exposure, small company exposure, large company United States. And they're going to have a experience where in any kind of down market that we might find ourselves in, this investment in a down market will outperform every other.
Yeah, you'll absolutely outperform the indexes. Like in this case, S&P.
If you just have a stock index, whatever that index does is what your return is, right?
Exactly.
So if the index is negative anything, we know this is going to outperform.
We'll do better. Absolutely.
Let's talk about the other side. Let's talk about the upside side of it.
Yeah. And that's where, so in order to get that protection or obtain that protection on the downside, what you do is you sell away some of that upside.
Okay.
Right? So we do that by selling a call option. And this is it comes into it's inside the buffered ETF. You don't see all this, but we basically say, okay, we don't want to lose that 10% from 0 to down 10. We want that to be absorbed, right? But then in return for that, what we're going to do is if the market's up, and I'm going to make a number up here, if the market's up 20, we're going to give up anything above 20%. So we're going to give up some of that upside potential in exchange for giving away that buffer between 0 and down 10.
So you don't get all the upside.
Exactly.
Right.
Lose some of the upside.
And I know you threw out 20. That was just an example. The cap, if you will, changes every day.
Yeah.
It's an actively traded market. Exactly. I mean, we're using options to do this. So, there's a lot of options are derivatives, so the price of the options are derived from volatility, from interest rates, so lots of different things.
Yes.
But I think, for the average investor out there to kind of understand it, it'd be perfect for the investor looking to hit a little bit more consistent singles and doubles.
Exactly.
Right?
Yeah.
Like, when we started this firm a long time ago, McCarthy Cox focuses on financial planning, and specifically financial planning for people very close to or in retirement. That's our specialty, and that's what we do. And so because we're working with people that have taken the last, 35, 40 years to build this nest egg, that they need to then use this nest egg to, take care of their income needs and expenses for the rest of their life, risk management, that downside risk management becomes honestly like priority number one.
Absolutely.
For a lot of people, not everybody, it's not the right, but for a lot of our clients, it's about keeping what you've accumulated. It's not about trying to grow it as much as possible.
That's absolutely, you're spot on. That's what this is. That's exactly what this is. I mean, we don't need to, not everybody doesn't need to hit home runs, right? And like you said, the losses hurt so much more than gains do. And
like mentally.
Yeah, mentally. Yeah. And math also. But mentally, if you look at like mutual fund returns or the average investor returns over, say, a 10-year period of time, it's about half or a third of even what the actual return. Because people jump in and out so much.
Because they get emotional about it.
Yeah. So if you get up tomorrow morning, right, and not you, but an investor gets up tomorrow morning and they see tariffs, markets, all turmoil in the markets, right, and the S&P's down 5%, 6%. If you own this product, you don't have to be concerned about that, right? You can't. You're probably still going to get a little emotional about the markets being down, but hey, I'm buffered against those first 10% of losses. It's not going to hurt me, right? And that's
if it had that 10% statistically, if we had that 10% downside protection, I'm sorry for cutting you off. Like if you had that 10% downside protection, like what percentage of the time would you, or how many down markets would you eliminate over that?
Oh, you're going to eliminate about 2/3 of your down markets in those situations, which is a big deal.
That's huge.
That's a big deal. Yes. And then the other thing, just investors are emotional people. Right. And even if they have a financial advisor, the financial advisor helps them stay invested, but they're still.
That's why returns with advisors usually are higher.
They're higher. Yeah. And emotions are still a part of this, though. But this is, to me, anything that can keep the investor in the market and smooth that ride out and get to an end point is an awesome, amazing product. And that's what this does. This keeps you invested. It's an asymmetric, and I don't know if I should use this word, but if you think about this, when the market starts going up with a buffered ETF, right? You start making money from the first percent. When the market starts going down, you don't lose right away. So that's what I mean from an asymmetric. You start making money right away, but you don't start losing it right away. Okay. And that's a pretty powerful thing.
It's cool.
And that's what I'm.
But we're not the first. We're not the first person to create a buffered ETF.
Yeah.
They've been around for a long time. I remember, these kind of came out of, we briefly mentioned this, like structured products.
Yeah.
We used structured products for now decades.
Yes.
In this firm. So we were very comfortable. Again, we work primarily for retirees. So we were very comfortable. We were trying to figure out risk management type investments that we could do. And that grew into a discussion of structured products with downside protection, stuff like that. So we're not the first person to do this, to launch one of these. Can you tell me what makes the trio different or unique from what was available already on the marketplace?
Yeah. So the 3 indices, that's part one, blending 3 indices and actually looking more like the global market and how people would actually invest. The second part, I actually think this is the most important part, for me anyway, is the reset feature, where we're going to look at this every month. And let's say the market, we launched this on April 1st, right? Let's say pick a date, April 1st. End of April, market's up 10%, the ETF's up 9%, and let's say we had a 10% cap. Well, if we held that for another year, the most we're going to make is 1% for those other 11 months. And this isn't like a traditional, the ones that are in the marketplace right now. What this one allows us to do with the active management component is reset that cap and that buffer at that point. So that's truly it. You're not set and you're not stuck in that 1 year period, regardless of what happens in the meantime, right?
Because you're actively looking at it monthly.
Exactly.
Right. And there's no other one that's active
Nothing
right now. Like we're
Nothing.
launching a completely new and unique
brand new
approach to this.
completely unique experience. And we've traded these ETFs we've invested in these ETFs for 4 or 5 years now, like the buffered ETFs. And these are things that we've seen, opportunities of maybe the pricing is a little different for different months and everything. There's opportunities that we see here to really take advantage of this in this reset period. This is going to allow us to do this.
Daily liquidity, low cost. I mean, we're excited. This is huge.
I'm more excited about this than potentially another trip to Disneyland. At Disney World. It's just
Have you been to Disneyland as well?
no, I have not actually.
Okay.
But I should go.
Yeah, my brother lives 20 minutes south.
I'm jealous, but yeah.
Well, Disney World's significantly better.
And more expensive probably.
Great discussion. Awesome discussion. Anything else that we missed? Anything that we should put out there that we didn't? If not, how about this? Where can they find? So let's just say that they, let's say you have somebody watching that's self-directed. They're not a client of McCarthy Cox, which a lot of our existing clients are going to have this type of investment option inside their portfolio. But let's say they just like to do their own thing, and they're at Schwab or what have you, or another advisor out there listening that says, hey, I work with retirees, I'd like to put this in a portfolio. Where can they find more information on this stuff?
All right. So more information will be available on our website, www.mctrio.com.
Okay.
So you can go there to
Get there and get actually all the fact sheets and all that stuff on it.
Fact sheets, daily pricing, all this fun stuff out there. A little bit about the firm, Jim, myself, and Previn. Yeah.
Very cool. Very cool. I appreciate your time. Love it. Now comes the fun part, which is another toast to retirement with juice.
With orange juice. Yeah. But hey, wait, Jim, here's the thing. I couldn't do it to you again, man. I just couldn't. I couldn't do it. Let's see if I get this out right. So, there we go. There we go. I got some champagne here. We're going to turn these into mimosas.
Oh, great. Oh, cool. So champagne to launch the new, that's so cool, man.
I don't know if I want to pop this thing, though.
Try it.
I'm not good at this, and
Nothing but the best.
nothing but the best. That's it.
About $4.99 or so. No,
Hey, it doesn't matter.
we are budget conscious. We've done this. Yeah.
That's it.
All
Yeah.
right, here we go. Let's see. Please. I don't want to get all over me. I don't know. How about it shake?
I did shake it up before it came out. Oh.
Yep.
Oh.
Nope. I knew that. Yep. Oh boy.
There's the notes down there on the floor. So
This is live, everybody. There we go. Okay. Not too bad. I don't need your notes anymore anyway.
no, we're good. I'm gonna hold this over here. I'll hold yours too for you. A little heavier on yours, Jim.
Well, all right, there we go. You get this mostly orange juice. Little bit of paint. It is a work. It is during the work.
Yeah, that's another part of this too, right? Like, it's not cold pressed though. Not cold pressed. But I wasn't going to do that to you again, and it's not gray.
All right, now, so I always have to come up with this toast, and sometimes I spend some time did it. I actually did. I think the first one I did take a little while to kind of design one. Today, I decided to cheat like so many millions of people in this world now are doing, billions maybe, are using this AI. And
what is this AI thing you speak of, Jim? Like,
we're not opposed to using AI, man. Especially when it comes to, it's not spending an hour to figure out a toast.
no, right? Like,
So I just Googled a good toast for a new milestone, a new achievement, and for forward-looking progress. And here's what it came, which I was like, this is great. It was the first one up. So, use AI, people. All right, ready? So, to new milestones reached, dreams realized, and the exciting path ahead. Let's raise a glass to celebrating our recent accomplishments and to the endless possibilities that lie in our bright future. Cheers to what's to come.
Cheers to what's to come.
Oh, yeah, we got to do that.
There we go. Yes, sir.
That's mostly champagne.
Yes,
There.
it is, indeed.
Yes, it didn't mix well.
We're going to take a little break before we get back out there.
It didn't mix well. Wes, thank you very much for your time. To everybody out there, you probably will seeing this around St. Patrick's Day, which is my national holiday. So Aaron Go Bra, happy St. Patty's Day. Toast to retirement. Thanks, Wes.
Cheers.
Cheers to you guys.
Thank you for listening to the Toast to Retirement podcast. Feel free to share with friends and family, and follow McCarthy & Cox Retirement and Estate Planning Specialists on Facebook and LinkedIn. Check out the podcast tab on our website, www.mccarthyandcox.com, where you can find links to all the episodes of Toast to Retirement. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general information purposes only and does not constitute either tax, legal, or financial advice. Please consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.